Welcome to the special summer series of the Market Huddle. I'm Kevin Muir. Patrick and I are both taking a break this week from our regular scheduled Huddle programming, but this has given us an opportunity to air an interview that I've wanted to do for quite some time. When I wrote my first piece about modern monetary theory, everything you always wanted to know about MMT but were afraid to ask, I was taken aback by the number of thoughtful, serious market practitioners who reached out to share their experience using this theory in their job managing money. There were some extremely impressive individuals with well-known street cred who admitted that they'd been using MMT for years. But I came to befriend one individual who was instrumental in helping me understand all the complexities associated with this new way of thinking. I found myself chatting with him regularly, adding to my knowledge of the subtle nuances in this new school of economic thought. And I'm pleased to say he has agreed to be interviewed today so that he can share with you the same insights that were so helpful in my development. David Bezic has studied economics at a graduate level and also earned an MBA. David worked as a macro researcher in various guises on both the sell side and buy side, including equity strategy, asset allocation, portfolio construction, and thematics. And the thing I like best about David, he is one of us. He is not interested in using MMT to forward a political agenda, but rather has come around to the theory because as a former Goldbug who became disillusioned that the markets were not behaving as predicted, David set about to understand what was truly driving the price of financial assets. His main overarching focus is to understand how the modern financial system actually works, and he is willing to toss aside the old economic dogma in his search of the truth. So let me keep the lawyers happy with my compliance disclaimer, and then we will just jump right into the interview with David. I hope you enjoy listening to it as much as I did conducting it. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. For more information, please visit eastwestfunds.com. Now, for those who don't know, David was actually a lot smarter than me. He figured it out way back in early 2011 that the world had changed, I think, and he didn't rely on the regular orthodox theory to figure out what was going to happen with QE, and had already started to question things. But up until that point, you had been a Goldbug, had you not?
Yes, that is true. I don't tell any of my kind of modern money cohorts these days. I try not to, but yes.
So why were you a Goldbug, and what was the thinking behind that?
Well, I think it was kind of the natural outcome of my conventional economic learning. So I think anyone who was educated with the current textbooks we have, it would have naturally landed in that camp when we started seeing QE coming, and all these new unconventional policies, and thinking about the size of the U.S. debt, and the only way they would ever be able to pay it off is if they couldn't do it, they'd have to inflate their way out of debt and all this sort of thing. So I was thinking, if we have money printing and debt that can't be paid back, we're going to get inflation. So what's a good hedge for inflation? Gold. And I got pretty hardcore into that world, so I know where a lot of the Goldbugs
zero hedge guy?
I was a zero hedge guy. I would go to the PDAC Prospectors Developers Conference in Toronto and hang out with all these Goldbugs. And at the time, I had a lot of gold stocks, and they ended up doing well, but not at all for the reasons I thought. So things turned out okay, but they didn't turn out okay because we ended up having inflation and dollar crashing and all that stuff. So that's when I started questioning it. Like, okay, it's one thing to be right, but if you're right for the wrong reasons, it's not good enough. So I started questioning at that point.
So where did you look at, what did you look for, and what did you start to find, and what started to change your mind?
I guess it was in my job. I guess just in terms of background, where I was starting from there. In that job interview, I was asked where I thought yields would be within 2 years or something like that, and I started saying things like 6, 7, 8, because of all this money printing going on.
That's right.
And
this is in 2011 or something? You were applying for something?
Yeah, it was about
and they asked you what you thought the bond market was going to be, and you thought it was going to be 400 basis points higher.
Exactly. And then one of the interviewers said, "Oh, what about double digits?" And I said, "Sure, why not? We're going to get so much money printing and all this." So it was in that job, actually, is just over time, again, things weren't working out the way I had anticipated. and just kind of started poking around the net a bit more. And I remember, I'd say one of the first places I encountered different ideas was Colin Roach's site, PradCap.
Right.
And I remember there were things that I liked, like reading in terms of markets, economy. But he'd always be talking about bank reserves this, bank reserves that. And I'd always just scroll down and think like, who cares? Who wants to learn about bank reserves? And then it just kept coming up. And one day I thought, I'm going to just give this a read. And then my eyes just started opening and started seeing things like banks don't lend reserves. And that's completely different than what I had learned in my textbook.
So it was Cullen that embarked you on your journey?
Indirectly, yeah. I'd credit him.
Yeah.
And then even guys like Ed Harrison, I encountered him quite early. And again, just saying things that were different, but
and Ed's
based in
credit write-downs, right? That's
right.
His site, terrific site, terrific writer, good guy.
Yeah, and they were saying things that were the more I thought about it, they were just based on fact, and they were just looking at the way things work at an operational level. As opposed to coming from some economic theory. And then after I had some ideas from them, I started seeing it show up in things like there was a Fed paper, I remember I think it was 2008-ish, divorcing monetary policy, or divorcing money from monetary policy. And there was some eye-opening things in there in terms of separating balance sheet policy from interest rate policy and how you could separate the two. And then I started reading those things from I don't know if you're familiar with Claudio Borio at the BIS. So I think anything he writes is a must-read.
Yeah, and is he still there at the BIS?
He's still there. He's head of, I think it's like, I don't know if it's economics research or money market kind of research. He's high up in the research world there. And he had a paper, and then even there was a guy at the Fed at the time who's now at UBS who's great, Seth Carpenter.
Right.
He wrote a paper on, I think it was called "Does a Money Multiplier Exist?" So it was one thing to see it from on blogs and stuff, but then when you start seeing it from the BIS and the Fed, it really got me thinking. And so that's when I went really deep. And then after that, it just started mushrooming from there. And then I started seeing people talking like this all over the place. And often they were people that were very typically either their job required them to be familiar with these things, so they weren't necessarily thinking of themselves as an unconventional economist. They were just a guy trading
like the short end
or
balance sheet or
people managing liquidity at a bank, things like that. And they're not calling themselves again unconventional economist or a modern money type, and they're just talking about their job and the way things work. And then a lot of the ideas that I was seeing from these kind of people just were very consistent with all the other stuff I was seeing with Cullen and in these new papers. So that's how I got there, and I just started going down the road at the time and haven't really stopped. There's something to learn constantly.
Well, I know because I have you were a lot smarter than me and figured out way earlier, but for me, I'll just briefly tell you my story. I had always kind of got onto Twitter and seen this MMT, and although I knew what it stood for, I didn't really understand the nuanced differences, and so I reached out to George Perks at Bespoke Investments, and I asked him for some advice and some stuff to read, and he sent me to Stephanie's and Randall Ray's kind of blog, and I started learning about it, and I asked him questions, and then I wrote a piece on it, and I wrote this piece on MMT in my blog, and I was shocked at the feedback that I got, and actually I think that's where we met you. You kind of reached out, and there was plenty of smart people like you that reached out and said something to the effect that I've been using this to trade for years, and like I've tell this story. I have somebody that's very senior, very well known trader that's been in some books, and he sent me notes from his Stephanie Kelton kind of meetings, and I was shocked at the number of people that were willing to just use MMT as kind of an understanding about how the actual economy works instead of how they think it should work, and were more willing to accept it. And I was shocked at the number of people out there that were doing it. And oftentimes I noticed the same thing. It was people that would do the plumbing, and there was people that would were actually trading in the instruments that we were talking about. So let's just get into it and talk a little bit about MMT. And although we're going to talk about more than just MMT, because too many people focus solely on that, and it often brings kind of some political reactions. I think what I just want to stress is that neither you or I kind of believe in the prescriptive part of MMT, meaning what we should do with it. We want to focus on the descriptive part of it, meaning that this is how the actual economy works. This is how market works. How can we use that to make our trading better and our investing better? So that's what we're going to focus on today. So why don't we go through MMT? You've had to kind of teach a few people throughout your career what it is, how it works. Why don't you give us your kind of main tenets about what MMT is and walk us through it?
Okay. No, not an easy task, but I'll just try and stick to some of the high level.
Okay, for sure. Let's
basics.
do it.
I guess the one place I'd start is MMT recognizes or makes a distinction between what they call currency issuers and currency users. So a currency issuer is the producer of a currency, and they do not, because they're the source of the currency, they don't face solvency constraints.
Right.
Whereas a user is anyone else that has to get that currency first before they can use it. So examples of issuers would be United States, Canada, Japan, Australia, not European Eurozone countries.
Right.
They're in this MMT world and in the actual world, ostensibly operating with what's a foreign currency, so that they're not the actual producer of it. Users would be me and you, province of Ontario, Walmart, and these Eurozone nations. And that's a key distinction. Like it's amazing to me in retrospect that I would say I used to think things like Japan's going to be the next Greece and not recognize this very fundamental difference. And one way I kind of think about it, and it's kind of glossing over a lot of institutional constraints and stuff, but in the real world, is when it comes to, say, evaluating credit risk of a sovereign,
right,
if we equate the two, it's almost the same as if you were equating or assessing the credit risk of someone going in to get a mortgage at a bank.
Yeah.
And in the first case, they have a certain level of income and the way we usually assess credit. In the second case, everything's the same, except the bank says, oh, by the way, here's the codes to our server. Go in and change numbers as you please anytime you like. So the credit risk in those two cases is very different.
Right.
And yet we, as the analyst community, less so now, but tend to analyze them in the same way.
Well, I'm not so sure less so now, because too often people still talk about Japan's going broke and the U.S. is going broke. It's ironic because people are still talking about we're not going to be able to fund our debt, and yet meanwhile it's going the other way. Boons are trading negative, Japan's trading at zero, and the bonds in the U.S. are rallying every single day.
Yeah. And so even though just one word I'd grab onto there is debt, and this might be controversial, I don't know if it's an MMT view, but to help me think about issuer versus user.
Right.
Users, when they have a liability, it's a true liability. And I think in that they have to go out and get money first, so they either have to sell an asset, they have to earn income, or they have to borrow more to pay off this liability. Whereas an issuer, we might call it a liability, we might call it debt, but it isn't really, because they don't have to do any of those things in order to pay it off.
Right, and so for me, that was actually a huge kind of wake-up call, and one of the points that a light bulb really clicked for me. That was my light bulb moment when I saw Stephanie Kelton talk about the fact that when a government spends, they spend first and then borrow. And then when I realized that whole idea that they have to borrow is a self-imposed constraint as opposed to an actual constraint, it just all of a sudden it made me rethink everything that I had kind of taken for granted. And I thought, well, if that's the case, then what does that mean? And it was kind of a series of well then, and all of a sudden I had to rethink everything that I was so sure of.
Yeah, and it's not just Stephanie Kelton and MMT people. There's even one specific example, a guy named Frank Newman. He's a former deputy Treasury Secretary in the U.S. He's written a few books one of them called, I think, Freedom from National Debt. And he's also said that that was the order of operations. And this is controversial. A lot of people will kind of argue about it. But I guess in terms of the operational reality, in his experience, he would say we would spend whatever needed to be spent, and then we'd go after the fact to go look to replenish the account. And I think the order really does matter, because when you think about it, when people say, oh, where's the money going to come from to buy treasuries, it comes from the spending itself. If the order really is spend first, so now that if the government adds $100 to people's bank accounts that weren't there yesterday, and then that's a $100 deficit, and then they go and issue $100 worth of treasuries, the money to buy those treasuries comes from that spending itself. And I think often what people forget is when we talk about the government borrowing, they're also spending. Whenever they borrow, they're borrowing, it's because they had spent. They're not just borrowing and stuffing the money away somewhere. So that leads to another key point, and it's MMT-ish or just accounting, is when the government runs a deficit, it's actually adding numbers to people's accounts, or it's adding net wealth or net financial assets. And that's because if it borrows from Paul because it thinks Peter doesn't have enough money, or he needs help getting back on his feet, they move the money from the first guy to the second guy, but then they give the first guy a treasury, and the treasury is on the asset side of our balance sheet. So by running through the course of running a deficit, they're basically spending by printing treasuries and adding financial assets to people's accounts.
Right, and so back to the idea of whether they spend first or tax first. I think the perfect example for me is that idea of about when the Japanese bombed Pearl Harbor, the Americans didn't go out and say, you know what, we got to replenish our military, we have to go build all these things, let's go make sure that we can borrow it in the bond market before we commit to it. They didn't. They just started spending. Mm-hmm. And once you start to think about that, you realize that there's always money for war. There's always the ability to spend. So the idea that the government doesn't spend first is ridiculous. It seems obvious to me that they spend first and then they go borrow, if they even have to borrow, and that's a story for another day or later in the discussion. Mm-hmm. So let's go on to number 2 here. That government spending is key to the fiat system. I think you touched upon that already, is the fact that money has to be spent to get pushed into the system, and it's like a tenet of how what MMTers believe. Yeah,
so I guess it's again not just MMT, but anyone that's focused on the accounting or the system, the flows. It basically comes down to, I think, an awareness of, it's what I call the Cotton Eye Joe approach to monetary economics. And I don't know if you remember that song, but
for sure,
one of the lyrics was, where does it come from, where does it go?
Yeah.
Where does it come from, where does it go, where does it come from, Cotton Eye Joe?
Yeah.
If you apply that similar logic to money and just think, where is it coming from, and where is it going, it can really, I find personally, keep me on the right track in terms of thinking about some of these things. So again, with, say, the U.S. dollar, ultimately the source of U.S. dollars is the government. And so in order for people to have U.S. dollars to pay their taxes or to buy bonds, the government has to provide it in the first place. And it does that either by buying things, giving transfers, and that's one way. In the modern economy, almost all money is created by banks in the course of lending, and that's a whole other discussion hopefully we can touch on later, and it's this concept of endogenous money. But even when banks create money in the act, so when they extend a loan, all they do is just add numbers to someone's account.
Right.
Those numbers are denominated in USDs. They're not actual real USDs. They're a claim on dollars.
Okay.
But standing behind that claim is the Fed, and banks are basically a conduit to the Fed and those real dollars. So, whether the money is provided by government spending or through banks and the Fed, ultimately it's the government that is providing those dollars. So again, it flips logic on its head, because typically we think, for the government to spend, it has to have people pay taxes so they have money. But MMTers would say it's the other way around. In order for people to pay their taxes, the government has to spend first.
Right, which brings us to the next point, which is deficits as a source of net financial savings. And the fact that someone's deficit is always someone else's surplus is kind of an important accounting, identity, in the fact that, and it again makes you think about things differently in terms of how the economy works.
Yeah, and I think it's a strength of MMT is that it's accounting aware, and I think the accounting can't necessarily tell you a direction of causation, but it at the very least instills a discipline on your thinking. And if we used to have people come in my previous job, analysts, and they'd say things about running deficits and everyone has to tighten their belts and all this, but if it's mathematically or accounting wise not possible for everyone to tighten their belts at once. There's someone for one group or person to tighten their belt and save or delever, someone else has to be doing the opposite. So it's just this accounting awareness. And again, I don't think it's just MMTers, and I think people like Ed Harrison are really good at getting this idea across. And there's an economist named Wynne Godley this was one of his big things, is this concept of sectoral balances. Janet Goldman's used this a lot in his analysis. And again, it's a discipline and a recognition that, again, for one sector, so say, for example, the non-government sector, to save financially, someone else, in this case the government, has to run a deficit and do the opposite.
Right, and so you have a chart that you go through which shows kind of the U.S. government deficit versus the private sector spending, and it actually looks like the mirror image of the two. Yeah,
it's the mirror image except for the foreign piece, so the current account.
Right.
But again, so if you can divide it up into government, non-government, include foreign in the non-government, they always add up. And again, for one sector to save, another sector has to dissave. It's
right.
Mathematically the only way it can happen.
Right. And so we put all this together, and so what is the real constraint that the MMTers believe the economy operates under?
So that's a very good question, because I think a common criticism you hear of MMT is it's kind of viewed as a free lunch. It's going to lead to inflation, and these MMT people just don't get it. I'd say basically the opposite, in that when MMTers talk about a constraint on spending, it's inflation. And so they view, again, it's not an ability to pay or ability to access funds is a constraint, rather it's inflation. And inflation, in their thinking, is a function of how much money is being added to the economy relative to the productive capacity of the economy.
Okay.
So there's a certain point where if you keep adding numbers to people's accounts, but productive capacity is not being expanded at the same time, and if people are actually using that money to spend, if it just sits in accounts, there's no impact. But if people are actually spending and investing, at some point you're going to get inflation. And also the constraint is I guess it's in real terms. So even to say, for example, if the government's spending running a deficit, in our textbooks we learn that they're crowding out private spending.
Right.
So in the MMT world, there is crowding out, but it's not the financial kind, it's the real kind. So if the government was building so many bridges that they were just taking away all the bulldozers, co-opting all the workers, and there's none left for the private sector, you would get inflation presumably in those factors of production. So again, the constraint is that real side and the real productive capacity.
Okay, so we got to take a break here, and I got to tell you, tell our listeners the story that you passed on to me about the idea that MMTers just don't understand about inflation. And you had a great line, because often the big kind of pushback is, oh no, MMT is going to cause all sorts of inflation, and you guys, in your new ivory tower kind of theories, don't get it. And you had you had a great story, and why don't you share it with us?
Okay, I guess the thing that I equate it to when I hear that, and it's coming always, the first thing people say, oh, that's inflationary. My first thought is really like people have been digging into this stuff for 20 years and going in so many layers deep. And do you really think they hadn't thought about inflation as a potential outcome of some of these programs? And then I guess one thing I equate it to is, I don't tell many people this, but I'm a big fan of wrestling, of the professional variety, not the amateur stuff. And I've been following it for, since I was 7 years old. And just over time, and as you mature as a wrestling fan, you understand more, you get deeper and deeper into the layers of what actually makes a good match or a good storyline, a good wrestler. And there's a lot of things to look at. And there's something called work rate, which is kind of like, how many moves or things are being incorporated over a certain span of time. And then there's ability to change storylines on the fly if the crowd's kind of turning against the good guy and all this kind of stuff. And these are the things people watch for and discuss, and that's what makes a good match or a good wrestler. And then after all these discussions, someone will come along and say, oh, but it's fake. And I just think, really, that's the level of discourse right here.
And thanks for letting me know. I never realized.
Didn't dawn on me.
And it's the same with MMT. It's like, thanks for pointing out that maybe inflation is the constraint.
Exactly.
And in fact, the MMTers acknowledge that is the constraint, and they argue it over and over again that is the real constraint, and it's not kind of a financial constraint. It's an actual real resource constraint that they do. So let's go on then. So we kind of understand a little bit about MMT and what it is. Let's talk about how we can use this in the real world and what you've found it helps in terms of somebody that's investing or trading and how you might change your thinking. Because I know for me it's been quite eye-opening and helpful, but do you have some examples of things that where it's helped you in terms of making portfolio decisions or investing decisions?
Yeah, I got several, just in that I've had enough years of using it now. Like you mentioned, I was kind of lucky enough, I would say, to come across it earlier.
I would call you smart, but
well, I don't know, maybe I just had too much time to surf the net. I don't know, but it has helped me a lot. So without going into detail, my job was kind of strategy and asset allocation at a macro level, asset class level. So, say for example with equities, it wasn't stock picking; it was more equities going to do well relative to other assets. And I would say it's not typical of a lot of MMTers currently, but I've been positive on equities for a long time, and a lot more positive than a lot of my coworkers or people at my work.
So why was that? What made MMT make you more bullish on equities? And this is, and a lot of people become bullish now, but the reality is that we have to think back kind of 3-4 years ago. It was hard to be bullish. Every hedge fund in the world and everybody was proclaiming the end of equities and that we were about to roll over. And, you kind of had been bullish that whole way up and continued to be bullish. So what about MMT made you more confident in that call?
I guess the main one is a lot of the negative views, I think, were, and probably still are, predicated on a view that the only reason stocks are going up is because the Fed's printing money. And, once they stop printing money, the balloon's going to burst and equities are going to tank. But again, because I had the opportunity to think through the accounting and look at what QE actually is and isn't, I came to the realization they're not printing money. Right. All they're doing when they're doing QE is changing one risk-free asset, taking away one risk-free asset, a treasury, and replacing it with another one, reserves. And so that's not really changing anything. It would if banks actually lent those reserves, but that leads to that other point I mentioned earlier about the money multiplier being a myth and banks don't actually lend reserves. So realizing that, you come to realize stocks are going up for other reasons. It might be psychology, so QE might be having a psychological impact, making people feel like, oh, the Fed has our back. So I would concede that, but it wasn't just printing money, and the money has to go somewhere, so it flows into equities. So basically it made you confident that QE wasn't what was causing it to go up, and therefore QT wasn't going to cause it to go down. Exactly. Because in essence, you almost view, like back to Warren Mosler talks about the fact that
we all sit around thinking that the Fed is the arbiter of all kind of financial kind of prices, but the reality is that they're like a child sitting in the backseat of a car with one of those play car kind of things, and thinking they're driving the car, but really, something else is driving the car. So what would you maybe argue is driving the car and causing us to go forward?
I think well, first of all, the starting point was very low. So that's one thing, is when people, a lot of the bearish arguments too would be saying, talking about the duration of the market or how long it's been going, and they're always picking the bottom. Like why not start a year earlier or 2 years earlier, and then you see we haven't actually gone that far. And there have been earnings. There has been, there's been economic activity picking up. But this, I think, leads nicely to another driver where awareness of MMT or operational aspects helped, is linking not the monetary policy piece to equities, but the fiscal piece.
Right.
So one thing, if you kind of follow the dollars, I came to realize, and there's people that write about this, so Sri at Levy Research talks a lot about this profit equation.
Right.
Montier at GMO.
Yeah.
And it's basically it's national accounting and breaking down the components of corporate profits.
Right.
And when you think about it that way, you come to realize, interestingly, when I saw this equation and thought about it, is we think of households going and, spending money in stores and they're a source of profits. When you add it all up in a macro sense, they're actually a net drag, because corporations are paying workers to build things. The workers typically save some, so then they're not spending it all back in the store.
Oh, yeah.
So they're actually a net drag on profits.
Right.
So in order to get positive drivers, you need a source of spending that doesn't come from the corporations themselves or the producers themselves. So the biggest driver historically has been investment. And then one reason is because one firm's paying another firm to build something, so it's a revenue source, but then it's expensed over a longer period of time or depreciated, so it shows up as profits. And then if workers aren't going to spend, if they're going to spend more than their wages, it's either they get some money from the government,
right,
it didn't come from the corporations, or they borrow money. So just going back to equities, and what helped me here was realizing a lot of people were quite negative on earnings, kind of coming out of 2009, and I think they were thinking, how can earnings possibly be good if corporate or households are deleveraging? But if you saw that there was going to be big deficits, that's a source of potential revenue for firms that isn't coming from them themselves. So that was another thing where I was able to stay more positive through that, just knowing that those deficits will help the bottom line. And I think Montier did in one of his pieces, I can't remember the exact year, I think it was 2011, he showed that I think it was something like 70% of corporate profits in the national accounts was sourced from government spending. And it's not just government paying a company to build a bridge. It's transfers, so government paying someone unemployment who then goes and spend it in the store.
Right.
So that's helped, and it's helping me now stay positive just because of what we're seeing, bigger deficits. And I think often people miss the link between what these deficits could mean
that's right.
for the bottom line.
I would argue that when you look at the kind of the performance of the world equity markets over the last little while, you'll see that the U.S. has been the best equity market out there, and everyone will talk about the reason for that, and they'll argue that it's American capitalism and all this stuff, and I kind of say yes, they're great capitalists, they're great people, but the reality is that they're running one of the largest debts as a percentage of GDP, or deficits as a percentage of GDP out there.
Yeah.
So no doubt that their economy is doing better because especially under Trump, they've cranked it. And I kind of laugh because he's running, a 4.5% deficit to GDP. Mm-hmm. And meanwhile, the Germans are getting all mad at the Italians for trying to run a 2.5%.
Yeah. And that's another example where this has helped me in that, say, when it comes to regional calls, the structure of Europe is, I'd say, I don't want to use the word disaster, but it's a
Okay, you can use it. It's
okay.
it's a pretty terrible, kind of straitjacket they put themselves under.
Yeah, so it's just hard to be positive on Europe on a structural basis until they deal with this flawed institutional structure they have. So as we talked about earlier, every Eurozone member is operating basically with a foreign currency, so they don't have any flexibility on that side. And then at the same time, they have no flexibility on fiscal, or very limited.
Yeah.
And then the monetary is being operated for the region as a whole. So what's good for Germany might not be good for Italy or necessary or optimal at this time. So it's just until they deal with that, and I think it doesn't even have to be a huge shift. It's just they got partway there, I would say, with the OMT announcement several years ago, and Draghi saying whatever it takes, and the OMT was those outright monetary transactions,
right?
And that helped bring yields down. And I think what it did is it shifted the potential breakup risk from being a market-driven one, where markets drive yields higher and higher in Greece, and then Greece says that's enough, we're out.
Yeah.
It took that risk off the table.
Right.
And it moved it to political risk and kind of populism, because the OMT program came with conditional requirements. So for a country to access this program, they'd have to put in all these kind of fiscal discipline programs.
Right.
And it was never actually used, and it worked in bringing yields down. But it's until they let go of that second piece and allow some fiscal flexibility, I think we're not going to get good growth, we're going to have this populist threat constantly there, and just kind of like a series of rolling mini crises, and that's exactly what we've seen. And
right, and it's and what's interesting about that is that MMTers like Mosler and Kelton, they had predicted this way back. Like when the euro was first instituted, they kind of looked at it and said this isn't going to work, because they understood the tenets of that you need to have an issuer of currency, and that they were basically giving that up.
Yeah, and it's funny you mentioned Moser there, because I remember encountering a quote from him and sending it around internally at the time, where he's describing what was happening in Europe, and very quite detailed in kind of the series of events. And then when you look at the date that the quote was from, it was 10 years earlier, and it panned out exactly the way, or played out the way he anticipated, just based on this understanding of the institutional structure.
I find that kind of the most shocking part of this whole backlash against MMT is the fact that there's numerous cases where you can see that this understanding has helped you as a trader / investor, and yet the kind of pushback is just so, I don't know, emotional and visceral. Like and I feel that if people would just stop, kind of like if they would just accept it a little more, and it's not accepted in that they feel like you have to go all along with all the different parts of MMT, but accept it in terms of understanding that the system no longer operates like they've been taught, they would be better off.
Yeah, I agree. And I think that visceral response, I'm quite familiar with it myself, and I found there's kind of just you could lump the audience almost into two broad categories, and it's basically people that are kind of, I guess, willing to think about it and give it a chance, and ones that just shut down like right off the bat. And I think there's two reasons. One is, and I know from myself, as I started reading Colin and Ed Harrison and seeing these papers, at one point I remember getting this like kind of hot sweat feeling, thinking, holy crap, like I've been telling people the wrong thing for the last 15 years, and that's a hard thing to do. And I had worked on the sell side in equity strategy, and so it was mostly like about equities, but bringing in the macro perspective. And right. So that my name was on these things, and it's a really hard thing to do. Or like we talked about being a Goldbug, I was like, oh my god, it's embarrassing. Like, no offense to Goldbugs out there, but it was.
I still think gold might work. I haven't drank the full Kool-Aid as you got, because I think that it could be still. Anyways, but it doesn't matter.
No, I want to just say I'm not anti-gold.
Yeah.
And I still own it, and I see a role for it in a portfolio. So it's not. It's just more about
thinking
the
that
thoughts at the time that were leading me to
the idea that it was going to all collapse, and I think that I understand that, like the fact that you were burying like your bars in your backyard and having guns and ammo, because this whole idea of that the system is so unstable, and that these deficits mean that they have to kind of implode on themselves and all these different things. And I agree with you. I was very much the same way. I kept looking at Japan. Maybe we can talk a little bit about Japan.
Sure.
I think sorry, go ahead.
Just on the visceral response.
Yeah.
Just one last thing, and I think it could be another avenue we could go down is it's hard to admit you're wrong, and once you do, then you kind of open up this whole new potential world. And two, a lot of the MMT type talk tends to be shrouded in politics.
Right.
And there's this political brand, I'd say, that's been applied to it. And as you mentioned earlier, there's a prescriptive and a descriptive piece.
Yeah.
We've been talking about the descriptive. That prescriptive piece tends to invoke a response in particular, with people that have a different political view. One thing I would say on that, and I think it's important, is even though it is and it has been associated with, I'd say, more like left and New Green Deal and all that, and that's a whole different discussion. We want to talk about the virtues of
Right.
those kind of things, but it can be just there's no set prescription that goes along with MMT necessarily, other than it could end up.
It could be a right wing. Like, I would argue that Trump is very MMT. He basically went and made a huge tax cut 8 years into an economic expansion, and he didn't care about the reality of that a Keynesian would be telling you that at this point you should be, paying down the debt. He didn't believe in that. And so I don't think that, and you go look at Warren Mosler. Warren Mosler is, I would argue, he slants to the right, don't you think?
I think so.
He's a little bit more of a libertarian, but definitely not a left-wing kind of the planet's burning, I got to do all this climate change kind of person. I'll talk to you a little bit about that, because I was on a show and I had a debate, and I was kind of with an MMT fellow, and I was shocked at how sure he was about the prescriptive parts of his policies.
Mm-hmm.
And then I was kind of like, I'm not really I don't have any confidence in what we should do. I kind of feel like I'm just trying to understand how it actually works in the real world. But I agree with you that prescriptive part is turning off a lot of people. And I think it's a shame, because I really do believe that we would be better off as traders, investors, if we all stopped to understand the descriptive part. Because I've yet to meet anybody that's actually showed me how the descriptive part, you mean the accounting identities, how all of these things are wrong.
Mm-hmm.
Like, everything everyone tells me is that it's going to eventually create tons of inflation. But we know that taken to its extreme, it will create tons of inflation. But that's not what we're advocating. Now, I'm going to let you tell the line, because it's your line, and I used it once, about the doctor. About the doctor. Do you remember?
No.
Oh, well, maybe it wasn't your line, or you've forgotten, and I've just taken it. But you said something I think that you said to me one time. A doctor would tell you that going out and running every day, getting exercise is a good idea, and that it will keep you healthy and it'll make you live longer.
I remember now, yes.
Yeah, but nobody says, well, I better not do that, because if I go and I run too long in the sun and if I run for 20 hours, I'm going to die of dehydration.
Yeah.
And I think that was such a great line, because they take this idea that maybe we should do a little more fiscal, and maybe we should think about these things a little differently, and they go, well, if you take it to this extreme, it's going to cause the end of the world.
Yeah. Yeah, it's the typical criticism, yeah. So when you talked earlier about inflation being the first kind of thing that comes up, it's always just assuming one particular policy prescription, and it's the most extreme one, and not thinking about something in between, or even things that are happening right now. This framework applies now. It can help explain what we've seen in the past 10 years, and we didn't have that kind of policy, but it helps at least understand it. And you can end up in various places. So to always go to that one extreme point, I agree. It's not helpful to anyone in terms of analysis or trying to get things right.
Now, having said that, I will criticize the MMT people, because I feel they make too much. I almost feel like a lot of MMTers are political people that use MMT as a tool to get what they want from a politics side of view. So they actually have an agenda. Their agenda is often climate change. They're like convinced. And I'm not here to judge whether they're right or wrong or whether it's good or bad. I do believe that, on the whole, pollution's bad, and that if we make the world kind of a less polluted place, we'll be better off. Now, to what degree, I don't know. I don't have any of those answers. But I do think that often these MMTers have political agendas, and they're just using MMT because they've looked around and said, well, I want to spend money, and here's somebody who's telling me I can spend money, and I'm going to grab hold of it. And that they really, truly are not, it's not like they believe in it as much. Well, they do believe in it, but it's just a stepping stone or kind of a tool to their ultimate goal. And I don't know what you find about that, like that, and it's kind of unfortunate because then everyone looks at those guys and thinks that that's what MMT is all about, and it's not.
I think it's not for me. It might be for those people, and there are like some of the founding names will talk about the job guarantee is an essential piece of MMT, and without job guarantee, it's not MMT. And so that's where what I say I came to this. I came to a broader framework. It's not just MMT. It's
right.
Things that include endogenous money, and you have the Bank of England talking about it, or it's just an accounting awareness, or things the front end trader type guys talk about at the operational level. So I do think that there are MMTers who say it's not MMT unless you have that stuff. But then at the same time, you have guys like Warren Mosler, who I believe his key piece consistently has been cutting payroll taxes.
Right.
So that's bigger deficits, but you're doing it in a way that's more supportive for business, for consumers. And that I think is interesting too, because a lot of that visceral response we get to MMT is, I think, often driven by the first kind of set of policies we were talking about. Whereas, if people say they don't like big deficits, and then often I'll say, well, so you like taxes? And they'll be like, no. But then, less taxes means bigger deficits.
Yeah.
All else equal. So you got to kind of, you just have to remind people of, it's not just the spending part.
Right.
It could be the tax cut part. And it reminds me I've met Warren several times, and he's talked about giving the same speech on the same day to two different groups of people, and one's like kind of, I don't know exactly, but a union type or labor group, and then the second group is a Tea Party, and it's the same speech, and both groups love it because one means less taxes, the other means more spending, and they all fall under an MMT possibility. But so I think it's kind of a shame that it's been so politicized, and I understand why it is, and I think there's a lot of promise and big good things can happen because of it. But it's just to get wider spread adoption. I think it helps if there's a greater awareness that it's not necessarily just that. It could be.
And don't get me wrong. I think the young people that are trying to change the world for a better, and they're looking around at the current system and saying the system stinks. We're not optimizing for anything, and there's got to be a better way. Hats off to you, and I hope that you guys are you hope you do it. And I just, for me, as kind of someone who's in the trading world, that's looking at these things, I find it. I guess it's maybe I shouldn't blame the people that are trying to make the world a better place like that. I guess it's our problem for associating MMT with those guys only and not kind of differentiating between the prescriptive and the descriptive. And just so you know, like we're neither one of us is really judging the prescriptive part. We're here to talk about the descriptive part. Yeah. So let's go on and let's actually, you mentioned endogenous money a couple of times, and why don't you tell us a little bit about that and what it means? And I know it was another one of those eye-opening moments for me that you kind of brought to my attention. This one was all you were my Cullen Roach, and you explained to me endogenous money what it was, and I was like, holy smokes, I can't believe I thought any different. So why don't you tell us about what it is and how it works?
Okay, that's not an easy task, but I will try. I'd say at a very, very high level, what it means to me is recognizing it comes down to me to the nature of money. And there's two broad kinds of money that I think of. And one is kind of commodity-based money, where it's a thing that gets passed around from one person to another. And in order for one person to use it, they have to get it. And if someone gives it to me, it means they no longer have it. The other type of money, and that first kind is the one that most people think of, even though we're off a gold standard.
Okay.
And it doesn't necessarily mean it's like commodity, like gold backed. It could be Bitcoin as an example, where even though it's a digital form, it's something that once one person doesn't, for someone to have it means someone else doesn't have it.
Right.
Or if you want to lend some, you have to pre-save it. The other kind of money is ledger-based. This is the way I think about it. It's not there's no textbook really on this stuff, I think. Ledger-based, and that's what we actually live in, where it's just a bunch of numbers in a spreadsheet, basically. And for that, you don't need to pre-save numbers to pass them along to someone else. And so one example would be running a bar tab. If I'm at a bar and I've had a few beers, and at the end my bill comes and I say, oh, can I just, pay you next week or whatever? They say, sure. So I've ostensibly spent money, I've consumed something, but in order to do it, I didn't have to say to the guy next to me, hey, can you give me like, $20 and then give it to the bar. It's just added on a spreadsheet somewhere.
Right.
And that's the way we actually work. And that second kind is endogenous money falls in there. And then I guess in the current context, what it means is, well, how it applies is most money, I think we talked about earlier, is in the economy is created through bank lending.
Right.
I think it's something like 95% of the money that exists was lent into existence.
Okay.
And so what that means is when a bank extends a loan, it doesn't actually go get money from somewhere, deposits from one person and pass them to someone else.
Right.
They're not an intermediary, they're actually a creator. And that's a game changer. So when I go if I want to get a loan, they're like, okay, here's a loan, and they just add $10 to my deposit side, and then they have a $10 loan as the asset. And that's a game changer in that all those ideas of crowding out that we learned in our textbooks, or the kind of constraints, or in order for a society to be able to invest, they first have to save a bunch of money that can now be directed to building a plant. None of those things apply in the actual real world, in this endogenous money world. And I guess the way I came into it more recently too was this idea of QE and, the Fed adding base money that we think can then be lent out and all that. And the fact that there's more reserves in the system doesn't mean there's more of an ability for banks to lend.
Right.
And that's a view that's consistent with this endogenous money view. And then another part that's consistent with it is that basically it's endogenous to the economy. So the amount of money that exists out there is a function of how much the economy demands of it.
Right.
So how many loans do people want, and then how many loans are banks willing to provide.
Right.
So it's determined endogenously by the economy as opposed to exogenously by the central bank. The central bank just follows along
Which
with
is
what
back
the
to Warren
economy is.
Mosler that the toddler in the back's not really driving the car.
Yeah. So it's on that, whether it's providing a quantity of money, and I think he probably, and I would agree, would apply it to rates as well. So we talk about rates all the time and them having this big impact on the economy. I'm in the camp that thinks they don't have that big of an impact for various reasons we can talk about after. But it's the idea that the quantity and the price. And actually one thing that's interesting there is, I don't know how it didn't dawn on me, from Economics 101, we learn a monopolist can either control quantity or price.
Right.
They can't control both.
Yeah.
Yet we kind of talk as if they do. And clearly the Fed has picked price of money. So then the quantity just has to vary to hit that price. This is before they started paying interest on reserves. So they had to either add reserves or take them away in order to get that hit their rate target. So there was kind of endogenous money staring me in the face, in the sense that amount of money, base money, was being determined by the economy, not by the central bank.
Right.
So one more thing is not just,
yeah.
and I think it's important, is that it's not just kind of me or MMTers or post-Keynesians, kind of this is their idea and thinking this stuff. The Bank of England has talked openly about this and actually written about it in their quarterly bulletin. So it's not even just a working paper by some research guy. This is their kind of, one of their flagship publications where they have it's called Money Creation in the Modern Economy, I think, and it's all about endogenous money and how it's created by through demand, basically.
Right, and one of the things that for me was eye-opening when we talked about this is the idea that banks don't lend reserves. And once you stop to think about that, it makes complete sense. So, going back to QE, everyone thought, oh, you're flooding the system with all these reserves. That's all of a sudden going to be taken up, and we're going to have, this massive amount of inflation because of all these reserves getting put into the system. And when you stop and think about it, you realize that banks are not reserve constrained; they're actually capital constrained.
Yeah.
So the Fed goes and does some QE. There's more reserves in the system. Does that actually change how many loans Jamie Dimon at J.P. Morgan is going to do?
No.
No. And it just, because you realize that he's not looking at, or their committee or whoever's running it isn't looking at their risk. I mean, like their loans to the amount of reserves. They're looking at their loans to the risk to their balance sheet or to their equity, and they're doing it based upon that. So there's actually this whole idea about banks being reserve constrained it was eye-opening to me, and it kind of made me rethink how everything works. And now the other thing that we can talk about is this idea that the economy might not be as sensitive to interest rates as we think. And we were actually at an event the other night, and you told me about a study that Goldman Sachs did, and it was a paper from a few years back. And once you explained it to me, I was like, oh, that makes complete sense. And it was about the sensitivity of corporations to the actual interest rate. So why don't you walk me through the thinking behind their their research paper?
So that one, if I recall correctly, it was looking at the sensitivity of the real policy rate to broader economic activity and economic growth. And they found that we had this kind of textbook relationship where higher rates are associated with a slowdown. It held up until a certain point in time, I think, kind of early 90s, and I think it's around the time central banks switched to targeting inflation. And then since then, not only did the relationship get weaker, the sign actually flipped. So
meaning that higher rates caused actual more economic activity and lower rates
or coincided with higher activity.
Okay.
So I think
I shouldn't say caused. You're actually much more proper and coincided. Okay.
I think it's a reflection of kind of the Fed just following the economy. Before they used to have a lot more of I guess now, if things are going well, they hike rates. So in the past it didn't necessarily work like that. And I think it's not just the broader economy, it's typically we would think about investment and capital investment and that being kind of helped by lower rates. And so not just Goldman Sachs, but there's a Fed paper. Ed Harrison has mentioned it a few times, even I think just this week, where they surveyed a bunch of CFOs from big Fortune 500 companies and found that basically the sensitivity of their investment decisions was very low to interest rates. So, lower interest rates wouldn't necessarily stimulate or
which makes complete sense. If you think about whether you're going to go build a factory, whether the rate is going to be 4 or 3% isn't going to be the driving force of your factory. It's not like you're going to be like, bonds back, fell 100 basis points this quarter. It's finally time to do that factory. The reality is that what the economic, your ability to forecast the potential for there to be consumers of whatever you're going to produce in that factory means way more than 100 basis points.
Yeah, it's the confidence around getting a positive outcome on that investment. And there's also these I think it came up in that Fed paper, definitely in an RBA paper where they found a similar outcome, was that the hurdle rates on these investments are just so much higher. They're like 15% or something, way beyond where rates are now. So being that far away, 25 basis points isn't going to really put a dent on a decision that's based on a 15% hurdle rate. And then not only are their hurdle rates high, they found, they're also, they don't vary much over time. And they've been the same basically for decades. And then, so going back to this point though about what matters more is either animal spirits or feeling good or feeling confident that people are going to buy the product that's associated with your investment. And one way I personally think about it is, a loan even at 0%, like it seems cheap.
Right.
But if you take that loan and you go and build a plant that produces something that absolutely no one buys, you still have to pay back the principal.
Right.
And you have no revenue being generated by that investment to pay back that principal. So that loan has now become very expensive. It's basically a 100% loan, or in a way where you got to get that money now from somewhere else to pay it back. And so it's the confidence in that investment generating revenue, or confidence in the demand that goes along with your product that matters a lot more. And I think even I'd like to get in not stats, but it's not even just, even if I expect this plant that I'm going to build to have a positive outcome.
Yeah.
And so it's overall I have a positive expected positive value from this investment. If the variability around that is high enough where,
right.
Even though I think it's going to earn me 20%, but there's still a 30% chance it gets me zero.
Right.
And if it gets me zero, I'm going to lose my job and I'm going to get fired.
Yeah.
I'm not going to build that plant.
It's,
right?
it's like somebody that gets the chance, you flip a coin and your payout's going to be, you can win $10 million if you win, and you can lose $1 million if you lose. But if your net worth is $1 million, even though that's a positive outcome, the expected outcome, you might not take that because it's too, the variability of the loss is going to mean too much, right?
Exactly, yeah. And that's the stuff that I would say plays more into kind of real economic decision making and not just fiddling with 25 basis points.
Right. Which is again why the interest rates don't matter as much as the fiscal policy.
Yes.
Okay.
I would agree. And one area where it does matter more is housing in particular, where you have people that are kind of stretched to a limit possibly, and they think they're going to get more house.
Yeah.
It's
like consumers will basically use up every dollar you give them in terms of like you put rates down, and they just whether they should or not is another matter. But most people will go out and say, "What can I afford? What will the bank give me?"
Yeah.
And they buy as much house as they're allowed. So that's the majority. So you're right that the sensitivity to interest rates affects the sensitivity of consumers for the housing.
Yeah. And this is actually kind of leads indirectly to what I think is an interesting point. And when it comes to private credit risks, in this MMT world or accounting aware world, if you recognize that, again, one, the government sector's deficit is another surplus.
Right.
If you're worried about credit risks and people taking on too much credit, you should support bigger deficits, because, say, all else equal, if consumers want to keep spending at a certain level and then the government starts running surpluses,
right,
in order to keep spending that same level, they have to get that money now from somewhere else. It's either running down previous savings or it's borrowing more money.
Right.
So,
which is in essence what happened with the American economy over the last couple of decades.
Well, and MMTers often point to the Clinton surplus years and then being followed by a kind of big blow up. And I think, I haven't gone back and looked at it, but I've seen MMTers talk about periods in the U.S. economy's history where they've run consecutive years of surplus, the government has.
Yeah.
And not only was every one of those periods followed by recession, they were actually followed by depression. And I think it was 4 out of 4, and then the 5th was the most recent. And it wasn't depression necessarily, but it was quite big, and it could have been a lot bigger if we didn't get, the policy stepping in.
Okay.
And that kind of does relate to something else we've talked about too, with when I say policy stepping in.
Yeah.
This is kind of going off on another tangent now, but we've been kind of poo-pooing monetary policy and it being ineffective. I'd say one caveat was coming out of the crisis and when things were really bad, that was actually effective policy, and QE1 being different in that it involved buying not treasuries.
Right.
Like just treasuries, because when they're buying treasuries, you're taking away one risk-free asset and replacing it with another one backed by the Fed.
Right.
QE1 involved buying MBS and kind of junkier things, or and that is in a way printing money. If I can sell something for 50 cents on the dollar on the market, but the Fed's willing to give me 99 cents, I don't know if they actually did, but now you're giving someone 49 cents.
Right.
Basically, right? So it's not that QE can never work. I'd say it just becomes a lot less effective when you're just buying treasuries.
Right.
But if they bought, and Colin's even talked about this. I think he's talked about Colin's bags of dirt. And if the Fed said, we're buying bags of dirt from people, that's printing money. And then once you go down that road, now that's actually a fiscal operation because you're adding numbers to people's accounts.
And which is, and this is often one of the things that the Goldbugs will talk about is another way to do this to make the inflation that everybody seems to want is that you go and you just buy gold, you set gold to a certain price. And I think James Rickards talks about this is the fact that the gold standard didn't not work. It's just that they set the price too low. But that's another story, and where that's the James Rickard special there. But listen, one of the things I'm going to do, I'll channel my inner James Rickard, and we'll kind of talk about the fact that, we sit here and we discuss all the deficits and the fact that the governments need to run these deficits so that the private sector has a surplus. And I think one of the things back to this visceral reaction that a lot of people have is they'll think to themselves, wait, that doesn't make sense. The government doesn't really create anything in this economy. The government's often associated with waste, and it's America wasn't built on the back of a government spending. It was built on the back of entrepreneurs and of things of this nature. And I kind of want to go down this road of talking about this idea that the government is a source of the problem, not a source of the solution. And I just maybe we could talk about this and the idea that the people on that kind of Austrian hard money side, the libertarians will say that this is not going to work. The government's going to waste it all. And I was just wondering what your response would be to someone of that ilk.
I guess my first one would be, again, I think a lot of those criticisms are aimed at a particular set of policy prescription.
Okay.
Again, it could be tax cuts. So I think a guy, I don't know, but I would presume a guy like Warren Moser is just thinking, he's entrepreneurial, he's started businesses.
He's made himself a race car.
Yeah,
Still one of the fastest race cars out there.
I think it was the fastest mass-produced or production car
ever
at the time, and he's since designed some new catamaran.
Yeah, like this crazy ferry system. The guy's obviously a very, very kind of dynamic entrepreneurial fellow. That's much more like a true entrepreneur and to the right than the AOCs of the world that are
Yeah, I'm not sure he's to the right, but he's certainly entrepreneurial.
Okay, fair enough.
I don't want to.
I shouldn't say left or right. I should just say entrepreneurial.
I don't know. He might be. I'm just not sure on that.
Yeah.
And but I think in his world, and I think rightfully, and it fits with, I guess it goes against some of these criticisms, is that he thinks just leave more money with the private sector.
Okay.
So that's what a bigger deficit is, and if it comes from tax cuts, if you want people to invest and spend money, don't take it away from them. Like, give them the tools they need, in this case, these tokens, these US dollars,
okay,
to spend,
right,
invest, do research. Don't take it away from them, is what he would say. So I think...
so he would argue that there's just not enough tokens in the world, and that's the real problem.
That's one of them. Particularly, you could get into distributional issues where there's not enough with the people that need it, and there's more than enough with people that don't need it.
Right. So for them, he would say that there's no problem with, the government doesn't need to spend it; they just need to tax it less.
They could tax less is one way, or they could spend, but it doesn't necessarily have to be spending on some bridge that goes nowhere. It could just be giving particular people that need money, more money to spend. Or they have the job guarantee. So in this case, it's not just giving it to them. You're giving it to them through the work that they do in the job guarantee program. Right. But then also, I think MMTers would say the government can help economic growth by building things. So building bridges, infrastructure that helps increase productivity, and that's where I think people would be wary that there's potential for waste or inefficient projects. But you can also stimulate growth and activity by building balance sheets. Okay. And so that kind of ties to what we're saying, where you don't take the tokens away, you add them, and then you help build balance sheets. In doing that, you help people delever, gain confidence, and at least you provide the fluid necessary to keep the engine running.
So that would be your response to somebody that was on the far right, or at least the hard money person, that it doesn't need to necessarily take away from the dynamic nature of capitalism. It's just that we're well. What's your analogy about the arcade? You have a great analogy about the arcade.
Oh, it's just a way I find to kind of help people think about this and talking about tokens is, and it goes back to the discussion we had earlier about currency issuers versus users. If you think about an arcade, in order for people to play games, there's often a special token, and you can only use a token from that arcade, like Chuck E. Cheese coins or whatever. And so the users are the people, in the arcade, and they have to get the tokens from somewhere. Right. And then that would be, Chuck E. Cheese or whoever. And if you want people to play more games, and say in the course of, people get paid in this economy that's like an arcade, paid to produce games that people like and all that, the last thing you want to do is take tokens away from this arcade and have, people walking around and they can't play the games, and then there's no incentive for people to build new ones. So you just got to make sure that there's...
That's a great analogy.
Yeah, so picture it'll be the saddest arcade in the world, right? Chuck E. Cheese keeps taking all the tokens away, and I think that's what some people want when it comes to policy, is like, let's take everyone's money away or not put any back in there. And again, I think there is a potential for waste, but it's also the potential for growth. Like, a lot of the internet came through government programs and military stuff, and a lot of R&D comes from that world. But I do think, and this might be a separate kind of discussion, but I do feel like I agree with MMT, just in the sense that there's nothing when it comes to accounting, the operational realities, how things work, there's nothing you can kind of poke holes in. It's the way the world exists, and right. If you're denying that, I'd say you're denying reality. But I do think there's, not that I disagree, there's parts where I think there's too much emphasis or not enough, and it kind of glosses over things sometimes. So one example would be when we talked earlier about sectoral balances, and there's often typically thought of as three sectors. You have the government, what they would call private, and foreigner. And in the private, they're lumping in, when you do this three equation version, corporations and businesses, as well as households. Right. But what happens within that circle, in that bubble, is very important in terms of the drivers in a capitalist economy. So, for example, typically you'd hear MMT people say, we want the private sector to be able to save. And right. And I agree. But if they're saving because corporates are hoarding money and not building plants, that's a lot different than having households saving because corporates are doing the opposite, and they're paying people, to build bridges or build plants and do R&D. Those dynamics between whether it's the corporate sector doing the saving or households is very important, and it gets kind of lost when you just lump them together.
So MMTers would often just lump the two and just talk about that as private versus government.
Yeah.
And they wouldn't differentiate enough between household versus corporation.
Yeah, it's not. I find it's not a big part of the discussion, and I think it's an important one.
Right.
And again, not that it's wrong. It's just the discussion tends to focus on other areas, and again, they're totally valid, and there's reasons for the discussion to be there. But it's just, I think it's helpful to kind of dive deeper into that private sector dynamic.
Yeah, and I guess like going back to your other comment about the pushback to the Austrians, the MMTers would never say governments need to spend. They believe that the governments need to run a deficit. And so whether that deficit is less taxes or spending, it has different political implications about how your society operates and what's going to happen to it. But they're never back to our descriptive part. There's nothing in MMT that's saying that the government needs to go out and spend and do these things. That's so. I guess to some extent, I'm doing the sin of falling for the prescriptive versus the descriptive.
Although I guess, again, I don't label myself as a particular school, and I don't want to put words in people's mouths, but I think that there are, again, if there's MMTers that say the job guarantee, without the job guarantee, it's not MMT.
Yeah, okay.
And that job guarantee is going to involve spending. You're paying people to do stuff. So
that's true.
In that sense, it might be, but then you have the Warren Moser, you can't have MMT without Warren Moser, and he tends to talk more about the tax cut side.
Right. Okay. So listen, let's talk a little bit about Japan, because I actually, that was one of my favorite, another eye-opening moment for me, in the fact that when you talk about their debt to GDP and how it's all going to come crashing down, and then I realized that through their QE that they were actually long on one side of their balance sheet and short on another. It was something that made me realize that maybe the system doesn't operate like I thought it did. And let me just kind of it was actually Bill Fleckenstein and the fellow from Jefferies, Zervos, that talked about this, and they talked about the potential for Japan to go out and wipe out their the amount of JGBs that they own on the Bank of Japan balance sheet, and what that would mean for the market. And I think, let's go back to a little bit about how we can use this in the market and what this might mean, because I think Japan's a great example. So let's first of all talk about this. Japan, I think that the Bank of Japan owns over 100% of their GDP in JGBs and a variety of different things. And then on the other side, the government is issued about 200 and odd percent of JGBs as a kind of on the short side. So we have a long of 100 and let's just say a short of 225. Let's just talk about, I kind of question, I ask people the question, what would happen tomorrow if the Bank of Japan just ripped up all those JGBs they owned? Just from an economical point of view, not from, let's forget about markets for a second. Let's just talk economics.
Yeah, I would think nothing.
Yeah, so I'm completely with you. I think that it's already a long and a short. It's like if you and your wife, you have a joint balance sheet, and she's issued debt that you've bought back.
Yeah.
It doesn't really, it doesn't change anything.
No, and if it did change things, it would have been at the time that, and I don't think it would really make a difference, but though, from the perspective of the non-government sector, so outside of BOJ and government, those bonds are already gone. They don't exist. So it's
right.
Unless there's no I don't see why there's no direct way for it to be impactful on the real economy, in the sense that they haven't been part of the real economy already for a while. And then if they were going to make a difference, it would have been at the time, say, if the BOJ bought on the secondary market, you change the composition of assets that are out there. I don't think that really matters either, because you're just, again, changing from one kind of risk-free asset to another.
Right.
But again, it's just accounting. And it might make people feel good if now all of a sudden debt to GDP goes from one big number to one smaller number.
So you say it might make people feel good. I actually think that the traders and all the doomsday guys, it would be the opposite. I think people would be instantly petrified. Like, let's just imagine the BOJ, like Zervo says, they have a little ceremony and they just have a little ceremonial burning of the bonds and then they just flatten it. I think instantly the yen goes from whatever we are now, 110 or whatever, to like 160. Like, I think that there's actually, like, from a market perspective, there's a knee-jerk reaction, and I think it moves hard. But then, like, if you stop and think about it, you are a money manager. All of a sudden, Japan is gone, and the value of Japanese assets in real terms have been, let's say, gone down, whatever that percentage is, 30% or whatever, and you're looking to allocate. So all of a sudden, you're faced with a Japan that is 30% cheaper and also can compete more against everybody else. So to me, I think you come in and you rush in and buy it, and I think that Japan ends up being one of the best performing economies around. Not only that, the true important thing is that now all of a sudden the government, whereas they used to think they had 250% of GDP and they couldn't spend anymore, now all of a sudden they go, we only have 150 or 100, whatever the number is. We can spend that again.
So
that's actually then it makes you, once you start to think about that, you realize that the whole 250, the fact that they thought they couldn't spend at that point, was self-imposed restraint.
Yeah. So I agree with all of that. And when I say feel good, it's that last part where, like, oh wow, debt to GDP is all of a sudden so much lower. It really didn't matter all along, and again, if it did matter, it would have mattered at the time that debt was created and the spending occurred.
That's right. So that was the inflationary point when the government spent that.
Yeah, and then I think people feel good. When I say people would feel good, it's people that worry about big debt to GDP numbers.
Right.
And again, I'd worry about it if it was me, Walmart, province of Ontario. I wouldn't worry about it if it was United States, Japan, Chuck E. Cheese. Because again,
Chuck E. Cheese was dealing in tokens.
So yeah, I agree with the scenario, and then again, I think people that worry about that stuff would feel good, and then it could actually be good, and probably would be good if it, after you get over that initial market scare and people kind of not knowing what's happening, if it really did lead to more a greater appetite for more fiscal, then that would be a good thing.
So a couple of things. Once you go down this road and you realize it, you think to yourself, okay, so the Bank of Japan, let's just walk through this. They spend money, or the government of Japan spends money, they issue a bond, they buy back that bond, and then they hold it on like a long and short. And this goes back to the idea that Stephanie Kelton, when I had my breakthrough moment, when she said you don't actually need to issue debt, that is a self-imposed restraint or constraint. And I realized that why does the Bank of Japan go through all of this rigmarole of issuing debt, buying it back, and then holding it on their sheets? Why don't they just spend it without issuing any bonds?
Yeah. So
do you see? And then once you start thinking that, you realize that how the system, when you realize that they don't need to issue those bonds and that this is how it really works, and yet they're doing this, and yet we don't have inflation in Japan, it kind of makes me think that, yes, the government needs to do a certain amount of that to actually keep the economy functioning.
Yeah. So on the question of why they do it, I don't know Japan's situation as much, but in the U.S. case, they have to do it in the sense that, again, it's self-imposed.
But it's legally, they're legally obligated to do that.
Yeah, and there's an account that the Treasury has with the Fed that can't go into overdraft.
Right,
they
TGA
always,
account. The
TGA, that's right. And then they have accounts with the banks that are called Treasury Tax and Loan, TTNL, which they don't use as much. Now it's almost all in the TGA. But that can't go into overdraft. If it could, and there's no reason it shouldn't other than these kind of self-imposed constraints, they would never have to issue a bond. So in terms of the reason they do it in the U.S. case, at least, is because they have to not let that thing go into overdraft. going back to Frank Newman, he said he can't recall there never not being a balance in there.
Right.
So, and then that you spend, so once you have a starting balance in there and you spend first, and that money's now there to buy the bond. So
right.
It's a kind of a non-issue. But it leads to a bigger discussion, I think, in that, like thinking about, say, where future policy can go, and now there's more talk about monetary policy being at the end of the line, and you're starting to hear more about potential for helicopter money, things like that. To me, helicopter money, it sounds scary, and you'll get all the inflation kind of stories, but it's really just fiscal policy in disguise, because it leads to that what you're talking about, where rather than adding, so the way it currently is now, when the government runs a deficit, it's essentially adding JGBs or treasuries to the private sector accounts. Instead of adding those, it would add bank deposits. And a lot of MMT, well, I'd say a key part of MMT is viewing those two as equivalent.
Right.
So, but typically, helicopter money is associated or thought of as being more inflationary. But if you think about it, whether I have $100 in a bank account or $100 in a treasury, if I bought that treasury, it was because I had already decided to not spend that $100. So first comes the kind of buy, save, or consume, save decision. And once you've decided to save, you then think about, okay, how am I going to allocate these savings? And if a JGB or treasury is an option, you might put it there. But again, if it's inflationary, it's inflationary. If it's going to be inflationary, it's going to be inflationary whether they print treasuries and issue bonds or they just add numbers to bank accounts. It's the same thing.
Speaking of helicopter money, Bernanke, who's the famous kind of originator of that term, he recently had a kind of a blog post that brought to attention a different kind of monetary policy, and it's actually much more akin to fiscal policy. What was that about, and why don't you describe to us what he was writing about?
Yeah, actually, that's a good question, good point, because I find he has a blog he has a Brookings Institute blog, and he had written about a 3-part series, I think, on kind of what where monetary policy can go next. And I find this one piece was just kind of overlooked, and I've brought it up with people many times. They're often surprised to hear. But he did talk about, I can't recall the details exactly, but it was basically an account that can be used by the Treasury for spending.
Right.
But the Fed would have control over how much goes in and out based on their assessment of inflation.
So when you say an account, it's like an actual fiscal account that they give for the government to spend a certain amount based upon the Federal Reserve's assessment of where inflation is. Yeah.
And I think, again, he didn't provide many details, and I recall even fewer of them. But the general idea, and I think the logic behind it, is to give he's basically recognizing, I think, that if you want to influence growth and inflation more directly, you have to do it through a fiscal means, and that is a fiscal tool. But if you're worried about inflation at the same time, give that tool to the people that are looking at and monitoring inflation, which is a good way to do it, I think. And I don't know how it works with the politics and dividing all the responsibilities. But a lot of the risks we hear about, like if we go down this certain MMT path, is presuming politicians won't be able to resist spending more and more, and then once you start, it's hard to stop. So the more control or influence you give to the Fed over that dynamic is I think one potential way policy could go in the future.
For sure, it's a fascinating thought, and let's just take it to example of ECB right now. They are doing just batshit crazy monetary policy in a desperate attempt to kickstart the last remaining private sector portion of their economy that they can, when really what we need is a fiscal lever there that they actually spend. So Draghi, instead of going out and doing even more insane policies, should just basically be handing checks to Brussels and saying, go spend these somewhere, somehow, however you see fit.
Yeah, and I think even if they did something, they don't need an extreme change. I think one thing that could even help there is just relaxing those limits, the 3% deficit limit, and you don't even have to like go out and give a bunch of money. Just allow a country to deviate from that
Right.
when they need to, and it's that flexibility I think would be enough to at least put it on a more sustainable path.
Well, I guess it's just because things are so bad now that it wouldn't take much to make it better.
Yeah, and they have programs. Well, they could do things. There's a guy named Eric Lonergan. He has a website and a lot of interesting ideas, and he talks about some of the tools that they could be using where it is almost like a fiscal tool. And again, I can't recall exactly, but I think what he was thinking of are things where you could, like as an example, the ECB could provide financing, say at a negative rate, and give it to the banks, as long as banks then give it to someone who uses it for a certain purpose.
Right.
So an example would be, I can borrow money at minus 10% to buy a car.
Right.
That's basically a subsidy because I'm getting $100 for 90. And a subsidy like that is basically a fiscal operation. So I guess what he's trying to talk about, and again, I don't want to put words in his mouth, but it's these kind of ideas where it's kind of providing a fiscal tool to central bankers, and that's another way to do it, where you
Right.
use rates for certain. It basically subsidize certain purchases, do it through the central bank if it's too hard to do it through the fiscal.
So I recently kind of have been talking about the fact that we're at the death of monetarism, that central banks are at their limit, and that this is no longer going to work, and we're going to basically be approaching a period where something's going to have to change, because we just can't keep doing lower and lower rates to try to squeeze out bring even more and more private sector demand forward, which is basically all you argue that lower rates does. I was just wondering how you see the world kind of unfolding in the coming years, and what if we do get a kind of a populist shift and a move towards MMT, what you would be doing in terms of your portfolio and where you see the risks and how you see it kind of playing out.
Mm-hmm. Well, I think if we do go down that road, say for example, if it was a response to populist stuff, the response, hopefully, and I think it would be a positive for providing more jobs, and kind of if we assume that unemployment is one of the sources of populism, things that address that would lead to higher growth. At the same time, you'd probably get higher inflation to go along with it.
Right.
So I would be thinking that we're if we go down this new road, the potential for not just higher growth, but also higher inflation is there. So I would start thinking about, positioning for that over the long term. So things like, real assets, real estate, things that can benefit relative to financial assets in that kind of environment.
For sure. And I've kind of thought about it in my head, and I've thought about the fact that growth stocks are, they're bid so high because of the reality is that there's such a desire for the little growth there is, and with interest rates so low, we have a situation where that's the longest duration asset, and it's been bid so high relative to what there's been the traditional value stocks. So I really think that one of the ideas is to think about everyday, mom and pop is kind of companies doing much better under an MMT, or at least a change in the environment, and and also a move away from financial the economy. I think that too often right now we try to solve everything with lower and lower rates, and going back to your idea that low rates don't really change the policy or the spending from most corporations. You could argue that that's all that those lower rates are doing is helping the financial sector, and that maybe we're about to embark on kind of a return to the old days, where good old manufacturing and good old value stocks do better at the expense of financing growth.
Yep, and I don't know if we have time to go down that road, but it leads to a discussion of the way monetary policy works and the way they've been trying to make it work, where it mostly it's not really adding anything to people's accounts. It's just either shifting the composition or shifting the distribution, or trying to raise asset values and get people to feel good and spend more. And those kind of things tend to help people that own the assets, the richer people. And it's also trying to get people to spend more out of current income as opposed to raising income levels. And again, that hurts relatively poor people as well, because they're the ones that, if the goal is to get people to borrow more, but if you don't have access to credit, it's not really helpful for you. So I think it's a shift, not just in terms of how the different kind of policy we're going to see, but it's also who's going to benefit from the more. So I think, as you're saying, not just business-wise mom and pop stuff and the kind of real economy, but also distributional and across income levels. I think it's going to start benefiting, hopefully, the lower end more and more. And I think fiscal is probably the way to do that most directly.
So do you think that's coming?
I do. Yeah, we're seeing, I think, signs of it everywhere where, if you look back, say 10 years ago, and you heard someone told you that in 10 years ECB is going to be buying corporate bonds, you'd think they're crazy. And we're at that stage now. It's kind of like the boiling frog, where things are happening around us, and we have BOJ targeting yield curve, like all along the curve. QE seemed so foreign when it first started. Now we're pretty comfortable with it. So things really are changing, and you have a lot of discussion now with the Fed, kind of reviewing their policy framework. And then, again, it was tucked away on Bernanke's blog, but even just talking about a fiscal tool for central banks, it just feels like these discussions are happening, and I think we're going kind of down that road.
Do you think that it's also a function of people understanding how the economy works better? Look, I feel like over the last, and maybe it's just me, but I feel like the economic kind of academic people have made great strides. Like I personally think all those DSGE models were just so full of crap. And if you had told me, I was an economics major, if you told me that I would spend weekends listening to lectures from a professor 5 years ago, I would have told you were insane, because I hadn't yet learned about Randall Wray and all those people. But once I kind of learned about this, I realized that here was somebody that actually understood how the system was working and was willing to talk about it, and was extremely helpful in my kind of trading and kind of investing. And I feel like that the economics, has taken a huge step forward over the last decade. Do you agree?
I agree, definitely. Particularly, I'd say in the last couple of years, and we saw the talk and the attention MMT was getting recently. One thing that was interesting about that too is I had lunch with Warren, kind of right when it was kind of peaking. And there's all these critiques coming out, mostly bad ones, talking about, didn't you think of inflation? And
Wesley's not real either, by the way.
Really? Thanks. And Warren pointed out that the fact that all these critiques were coming out, and yet the discussions were just continuing.
Right.
So it was kind of like, it was at a point where people have kind of moved on from that. And if these critiques were coming out a few years ago, then maybe the discussion would have stopped. But it seems to have reached a point now where the discussion's continuing. I'm finding even with friends, people that aren't involved in markets and stuff, will often have heard now of MMT or different ways of doing things. And then you're even getting it in, like I mentioned earlier, the endogenous money concept, and Bank of England openly talking and writing about it. That's a pretty big shift. Or even like MMT people will often point out the fact that interest rate on sovereign debt typically has been lower than growth, so I minus G, and then that leads to, interest rate being less than growth. Yeah. And that's an inherently stable system, in that you can grow your way out of debt.
Right.
That concept hasn't been talked about in the past that much, but now you even have Blanchard talking about it. You recently did a speech on it or a paper. And so all these ideas that are kind of unconventional, they just keep popping up more and more, I find. So I really feel like there is a tide shift.
Yeah, I saw even Ray Dalio was kind of embracing it. He didn't want to call it MMT, and he's come up with his own way of talking about it, but it's not that far off. MP3, whatever.
Yeah. I think we know what he's really talking about, and I think it is very MMT-ish.
Yeah. So even when the richest hedge fund manager in the world starts to kind of acknowledge it and talk about it, you know that it's reached more of the mainstream.
Yeah, and there are even people who've been there for a while, but they're kind of coming out of the woodwork a bit more, I'd say. You know, you got guys like, well, he's been talking about it for a while, but Paul McCulley, and he says he's not a card-carrying MMT member, but he's sympathetic to, I think, most of their ideas, and he talks at some of their conferences and things like that. So you got people like that coming out. From my work experience, I found I recently did a trip to New York, and the analysts I talked to, I kind of handpicked them because they're based on their writing and the things they talk about. I found it interesting, and even if they're not MMTers, they might be people that just understand the plumbing at a very deep level and that sort of thing. And in those meetings, they were all saying, like, everyone's talking about MMT, and they won't. There's some in particular, I would say, who they're at a big firm, like big name firm,
right?
And my sense was that they felt like they couldn't just write about it, but if you ask them, they'll talk to you about it.
Closet MMT.
Yeah, and the one guy was even saying, like, you know, he's been following Mosler and these guys for years, and I could tell in some of the things he was writing, and then it came out further in the discussion. But it's interesting in that it's still, there's momentum, and like they pointed out that people are asking about it more, talking about it more, but it still is at a point where if you work at one of these big firms, there's some kind of either reputational risk or, you know, career type risk for going way off the kind of conventional stream. So it's still at a point where you kind of have to go there in person and ask them about it, and then they'll talk to you.
Right. We saw the other day, why don't we just finish it up with the idea of Ray Dalio was talking about the nuclear option of China selling all their bonds.
Okay.
And I guess we could do one final thing about how MMT might affect the markets and how we might think about that. Do you worry about that nuclear option and knowing what you know, and what would you tell the people that are worried about China pulling the trigger on that bomb kind of option?
I don't think it's a worry.
Okay.
For many reasons. I guess the main one being, it's kind of like, I guess more of a technical one, but the way I think about what drives bond prices or what drives yields, if you think about it as a function of market expectations of future short rates and policy rates.
Right.
And expectations about growth and inflation. And then the term premium, which is a function of, it's kind of like a catch-all for sentiment. It's kind of like a PE for bonds, and there, regulatory demand, those sorts of things. So those are the way I kind of compartmentalize drivers of yields. And if none of those change because China's doing something, then yields shouldn't change, or your kind of perception of fair value of yields shouldn't change. So there's no reason why China selling treasuries, I think, should make me think growth is going to be lower in the U.S. or possibly inflation if you get a currency impact. And then on top of all that, if things did get kind of too hairy, the Fed has already shown us they're willing to buy bonds in the market. So if they didn't like what was happening, the Fed will just, I presume, would just buy the bonds.
Yeah.
So it's, in Japan showing us now, the central bank can set the yield curve anywhere they like if they want to, or if they feel like they need to. So I don't think the Fed is going to stand by and let China disrupt markets if it ever got to that point.
Yeah, and even if they did disrupt it, it would just be a short-term event. It wouldn't really be. It's not like we just went through all the reasons why it doesn't matter that a sovereign that issues its own debt can doesn't need to worry about those sorts of things, because it's not like I guess it goes back to people think we're borrowing all this money from China.
Yeah.
And actually, I thought here's a funny thing I was laughing about the other day. I was thinking about these fellows that talk about, we're borrowing all this money from China, and then they'll go at the same breath talk about how China is the most indebted country around and is going to implode.
Mm-hmm.
Like, how do you guys square these two kind of thoughts in your head? Are we, like, I guess, are they trying to imply that China is borrowing, money to invest in the U.S.? Like, I just don't get where they're going with this. Like the Kyle Basses of the world, I think it's this end of the world kind of thing that's going to happen in China. And I think we've talked about this in the past. That China has actually embraced a lot of these theories that we've talked about today, more so than other governments, haven't they?
Yeah. So in China, we've seen numerous examples where China, if they decide they want to build a bridge, that bridge is going to get built. I don't know if you've been there recently, but the infrastructure is quite impressive. And even, I remember seeing, I think it was like 2 months ago, they wanted to have a bunch of trees planted because of the pollution problem, and they got some crazy number of trees planted by getting a bunch of people to do it. I think people from the army and stuff, but it's just an example. They have clearly political issues and things, we don't, as a society, I don't think want to go down that road here.
Right.
But they're very MMT-ish. The most, I'd say, obvious example of MMT when it comes to just either building new infrastructure, getting things done, or providing things that are needed to help economic growth.
Well, they actually saved the world in 2008. Like, everyone talks about the U.S. and TARP, and I actually think that if we think back to the markets, it really wasn't until China came out a couple of days later after TARP that the market really took off, because their ability to put money into the system, and it's a lot more direct. Mm-hmm. They don't have all the constraints that the U.S. have, and so their ability to spend and do things it's much quicker.
Yeah, and I agree, and they're particularly if it's domestic, they can do whatever they want there, basically. When it comes to the foreign, and just going back to that issue of the U.S. borrowing from China and that kind of conflated argument.
Yeah. And
I find a lot of those, I just wonder where people who have those arguments, where they think the money is coming from. There's no, as MMTers often point out, there's no one with a printing press churning out U.S. dollars in China in someone's basement or something.
Right.
All those dollars came from the U.S. in the first place when China sold them goods.
Right.
And now China is just giving them back and putting them in treasuries. So again, it goes back to that idea, thinking about the Cotton Eye Joe approach. Where is the money coming from, and where is it going? It's coming from the U.S. So how can we say, or people will say, U.S. is borrowing from China? It's really China's getting money from the U.S. and just redirecting it into treasuries.
Right. So when you think about going forward, what keeps you up at night? What do you worry about? You see all these things. Like, what do you worry that you might get wrong? You might look back and go, I got this wrong and stuff. What are your concerns that you have? Kind of putting you on the spot.
Yeah. I'm generally more positive on markets than most people, I find.
Right.
I think some of the stuff when it comes to private credit, and that's where the risks are, if there are going to be risks, like if you're going to worry about stuff like that, worry about the people that need to get the money to pay off their debt. Don't worry about the ones that create it.
Right.
So it would be somewhere in, some kind of, I don't know if it's corporate debt or household debt, somewhere there. There's nothing really jumping out to me right now. It's not like there's a particular sector that looks, like when we had tech or housing. So there's, I guess, some of the private stuff just in terms of the amount of funds that are piling in and feel like they have to participate, and maybe they don't have the expertise, that is maybe looking crowded. But I think too it's not systemic, so you might get particular investors getting in trouble, but I don't think it's something that's going to necessarily, kind of rock the whole system.
I kind of think about, so first of all, on the private side, I completely agree that there's some worrying signs that, especially when it comes to the equity side, you see these unicorns that are trading at valuations that when they come to the public market they can't justify, and it actually trades down on the public listing, and because the amount of institutional investors that have pushed the price up in the private market has been so high. But I worry about the idea that we're going to convince ourselves that we can't go fix our problems because of all this debt. And like, so I sit here and I look at what Europe's doing, and the idea that they're doing more and more monetary stimulus with fiscal austerity, and I worry that is a recipe for disaster, and that eventually the system cracks because we don't understand how it really works.
Yep.
And so I'm very, very concerned that we don't get the message out, and that we don't shift, and that this same kind of orthodoxy continues, and we just try to do more and more until the system finally implodes on itself.
Yeah, and I think that is very valid, and I think it relates to the stuff we talked about earlier with the real constraint being productive capacity and not the financial stuff. But because we're so worried about the financial stuff and how we're going to pay all these Social Security benefits in the future, we're focusing on that, and there's real potential problems to not build. If we don't build the productive capacity at the same time, then we're just not going to have enough stuff for this aging population. So one extreme example, and the way I think about it, is if you had so you have an aging population, and it gets to a point in an extreme situation where you have one person left who's working age, and you have all these old people that they have to support. The issue isn't whether the government can give those old people their Social Security checks or old age security. They can always just add the numbers to the account. The issue is whether that one guy left who's working, can he produce enough food, enough medicine, enough transportation for all these other people.
So if we don't invest enough, that one person won't be able, or whoever's left won't be able to, facilitate what we actually need.
Exactly. And if we don't do, R&D and build productive capacity, CapEx, investing, because we're worried about the numbers, the ability to add the numbers, that's a shame, because the real risk is on the real side, not on that financial side.
Well, that's a great way of putting it.
Yeah, and
that is where the real risk lies. It doesn't lie in the fact that we can't pay that off. The real risk lies that we become so convinced that we can't pay that off that we don't invest on the real side.
Yeah, and there's a great analogy that Randy Ray did years ago. I think it was a bus company as an example, and he said, we have this program where if people retire from the transit company, they're allowed to have a lifetime of free rides on the transit system that they worked on for years. The issue isn't whether the transit system can provide those retired people with tokens to now come onto the subway. It's whether you have enough subway tracks, enough subway trains to actually let all those people onto the train. So again, it's that idea of a token, and the token issuer, you don't have to worry about them not having the token. They're going to be able to print it up. It's whether people can use those tokens in the way we're hoping they can.
Well, that's great. Okay, well, thank you so much for being with us. So for those who want to reach out and chat with you, I guess Twitter's probably the best way. Why don't you give everyone your Twitter handle, and if anyone wants to kind of chat with you a little bit more about it, they can reach out there.
Sure. It's I can't even recall it. It's my name's, I'm going under David B, and I think it's Junkbond 2000,
okay,
which goes back to an old wrestling discussion board name.
It's that wrestling is over. It kind of seems to be that's the most. I'm going to double check and stuff. I guess I sprung that out on you. There's
also LinkedIn.
Oh, there you go, LinkedIn. You get a good Microsoft kind of plug there. Yes, it is Junkbond 2000.
Okay.
And David B, and you can go there, or you can go and reach out to David on LinkedIn. And it's been a pleasure having you. Thank you so much for coming. It's been a lot of fun.
All right, thank you. It's great.
Hey listeners, Lena here. Thank you so much for listening to this special episode of the Market Huddle. Please follow Kevin on Twitter at Kevin Muir and Patrick at Patrick Ceresna. And if you haven't done so already, subscribe to our YouTube channel and sign up for our weekly email on markethuddle.com. Patrick and Kevin will be back with our regular show format next week. Now, crack open a beer and have a great Labor Day weekend.